In my last video, I discussed the bearish case for the stock market, and I said I believe we could be setting up for some type of a blow-off top where we could keep rallying on the S&P 500 and FOMO brings in more FOMO and it completes the build up, and then someday the market wakes up to reality and then we fall down pretty sharply until the market actually reflects the underlying fundamentals. And that's my main bearish case on the stock market. But I did get a lot of arguments around the bullish case of the stock market, which are things that I am looking at, because I don't only look at one side of the story, as I don't care if the market is going down or is going up. I just want to know where the market is and if the market is actually trading on fundamentals or not. If it's not trading on fundamentals and fundamentals are bad, I have to remain a little bit more cautious and actually to protect my capital. I value protecting my capital more than making money in the stock market. So in this video, I have a couple of things that are actually pointing out to a bullish type of stock market, some type of a bull case for the stock market, which could actually be indicating that maybe the worst is behind us in terms of the declines, in terms of the reversal, and maybe there's something a little bit better for the future. And I'm going to share those things with you today. Now, the first one is the technicals. As most of you know, the fundamentals for the stock market right now are bad. But the technicals are actually pretty bullish, and they are speaking a completely different language from the fundamentals. Now, I am personally a fundamentals-based type of investor, and I only know basic technicals. And I normally use technical analysis to get in and out of my short positions whenever I'm, doing such things. So this is a chart of the S&P 500 in 2022, and this is the channel that we've been in all years. And this is what I was basically doing. As we got on the top of the channel, I was opening short positions and I was covering those short positions as we go down. When we go down, I buy, a little bit of some stocks, some things I find undervalued, and then we go back up. Then I open another short position. This is what I've been doing pretty much all year. But we recently had a divergence over here where we actually made a higher low. And then we broke out of the channel around 5.5%. A breakout. Now, something else which is the most important thing when I talk about in this video is actually the golden cross. The golden cross is the 50-day moving average, which is the blue line, and it's the 200-day moving average, which is the yellow line. And whenever the 50-day moving average crosses below the 200-day moving average, this is called the death cross, meaning this is normally a start of a bear market. There's something bad in the future could potentially happen in terms of decline. And we're going to take a look a little bit at some previous stock market crashes to get some indication of how those things actually played out, and they have been very accurate. Now, if we zoom in here a little bit, we can see that the 50-day moving average crossed above the 200-day moving average, which is called the golden cross. And basically what it means that the worst is behind us. It means that the bottom is in, and it means that there's maybe some type of a recovery or some better times ahead of us. And we're going to take a look at previous market crashes and see how this happened. This was March 2020. It was pretty late for the 50-day to cross, for the death cross to happen, but it did happen. The main reason it was a little bit late because we had a pretty sharp, quick decline. And then once we got the golden cross of the 50-day crossing above the 200-day, it marks the end of the stock market crash, and we had a pretty amazing recovery for pretty much another year and a half until we started having the decline and we crossed again. Looking at another cross, which was in 2016. And this here, we crossed on a 50-day, below the 200-day on a death cross. We did have the market crash. Then we went up. Here we had a fake cross. And this is pretty much the only one that I was able to find where we did cross above the 200-day moving average. And it basically said that the market crash is done. And then it quickly reversed back down below it. It was a fake cross pretty much. And then we made another decline. But then once we crossed it again, we got the golden cross. Then we pretty much had an amazing recovery for years and years to come. This is the 2008 financial crisis. Again, it's the same exact thing. We had the death cross down, which means that this is the start of a bear market. Then we went down a lot on the S&P 500. Then we had the golden cross. And after we had the golden cross, it meant that the worst is behind us. And we made a pretty big recovery in the S&P 500. This is another one. in the 2001, which is a lot of people compare this whole thing for the 2000s, from 2000 to 2003. We again had the death cross, which is a 50-day crossing below the 200-day. It marked the start of the bear market. We had it, and then we crossed here, which was actually a fake cross. We crossed a little bit above it, and a lot of people claimed that the bear market is over and all that type of stuff. But we quickly crossed below it, and then we shot massively back down. And once we had the golden cross of the 50-day crossing above the 200-day, this marked that the worst was behind us, and we were entering some type of a recovery, which we have entered for years and years to come. Pretty much. So looking at this indicator of the death cross and the golden cross, they have been very, very accurate. And for us to really determine if this is some type of a fake crossing or not, the market has to reverse in a week or two. Like, it has to reverse on a CPI or something for it to cross sharply back down. Now, that doesn't mean that if some black swan event or something happens, the market can't just crash and just come falling down. This is just a technical indicator. But in every pretty much bear market we had, in every stock market crash, once we had a sustainable cross from the 50-day and the 200-day, it marked the end of the stock market crash. Now, the main problem with this whole thing is, yes, it worked before. It worked in 2020, it worked in 2008, and it worked in 2001. But whenever we had such decline, and whenever it did cross, we had pretty good fundamentals. I mean, we had something undervalued in the stock market. We had the Fed already cut rates by 2, 3, 4%. We had a lot of things which we don't really have right now, which means that we do have bullish technicals, but we have bearish fundamentals, which lead me to believe that yes, this is some type of a bear market rally, but it's maybe not like the bear market rallies that we have seen before, and it could actually take a little bit of a longer time for us to come back to those fundamentals and actually make the big correction that we have been, talking about, as I don't believe any rally is sustained on bad fundamentals. Eventually, some catalyst is going to happen. Maybe a bad CPI, maybe a hawkish Fed, maybe something breaks from all those interest rates we're hiking. Something has to happen. We don't know what could happen. But if just one thing happens and the market wakes up to reality that a lot of those stocks are overvalued, that earnings are declining, and the S&P 500 multiple is very, very high compared to what you're getting in yields, which are pretty much, is essentially going to go up based on what Powell said. Whenever we have that, which the market is saying based on those technicals that this is not going to happen today, it's not going to happen tomorrow. Maybe it's going to take another 3 to 6 months. Maybe it's going to happen in 2024. Maybe now we are sitting in 2007, and maybe this whole recession is not going to happen before 2008 because of the labor market and all those type of things. This is what I interpret of a message from the technicals in the stock market. If we don't reverse on the CPI that's coming up, to me, this looked like a pretty bullish, breakout, but this is nothing to be excited about because it's not based off any fundamentals, pretty much. If we had solid fundamentals, we would have a much stronger sustained recovery. But what I interpret from this, technical analysis is that we're going to reverse eventually, and the market is going to come back to earth. But maybe this day is not as close as we actually think, which is why, again, I'm not 100% cash, because I don't try to time the market. I keep my long-term positions, and what I'm doing, I have 6 months puts on the S&P 500. I'm pretty much trying to hedge my exposure a little bit. Once we actually break down and maybe we close a little bit back in the channel or somewhere where I can at least measure some type of resistance, then I can potentially enter a bigger short position. But I'm not going to keep, doubling up on SQQQ like a lot of people are doing, because the market is clearly speaking a message that maybe this day is later than we actually believe. But again, things could be wrong. Something else that's a little bit bullish for the stock market is actually the weaker dollar. And this is something that Mike Wilson talked about, and he's pretty much one of the biggest bear and one of the few bears left on Wall Street. And he actually said that this could be a tailwind for stocks, but only in the second half because it has some type of a delay. As you have seen with many companies, they are still experiencing currency losses despite the dollar actually going down. And he said because it has some type of a lag effect where it could happen in the second half of 2023, where actual companies post currency gains instead of currency losses. This is also bullish for the stock market. Something else that could be bullish for the stock market, and it's happening, which is lower inflation. But the way Powell is actually acting, used car prices are picking back up, and a lot of other commodity prices are picking, back up. And as the dollar is going down, this is going to eventually put up a little bit of pressure on commodities, pressure on inflation, and on, pretty much a lot of things. And when you have a tight labor market and people getting higher and higher wages, increases 4, 5, 6% wage inflation, this is going to be very, very hard to actually bring inflation down. And Powell is actually talking about this, which again could mean that maybe the Fed has to raise rates to 6%, maybe 6.5%, or maybe the Fed is not going to cut in 2023, which is not what the market is pricing in. The market is pricing in, I believe, somewhere around 5%, and is pricing in cuts in 2023. And this is, again, another catalyst that could bring the market back to reality, as it's now trading on hype and on the technical picture. It's not really trading on any sustainable fundamentals, in my personal opinion, unless we stay flat for a year and a half, for those companies to catch up on their, EPS growth, for them to be undervalued. And when you have such bullish technicals, but you also have bearish fundamentals, and you have the yield curve, which is the 10-year minus the 2-year, the most inverted since pretty much the 1980s, this to me actually speaks for trouble. It speaks to something bad that could break, that could happen, where again, people will claim that no one, saw this coming. So I shared what I'm doing in my portfolio. If I find some type of a company that's undervalued, I buy this company. I tell the people in my group, we don't try to time the market. Many people join my group and they see my market crash videos and they say, hey, should I sell all my stocks so we can buy them cheaper later? I tell them, don't do that. This is timing the market. We are not in the business of timing the market. We are in the business of actually looking and seeing if there's potential danger that could come in the future. And with the way the market is acting, and we have all the meme stocks and the things are pretty much going up, and the market is overvalued relative to bond yields, and inflation is picking up, and it could potentially pick up even more, which could surprise the market, combined with a yield curve that's inverted the most since the 1980s. I would want to be a little bit defensive, which is why I'm keeping my stocks. I have some type of hedges in terms of put options that I'm keeping. Maybe yes, I lose a little bit of money on them, but I'm net long, meaning my portfolio is going up, but I'm also staying cautious, keeping a little bit of cash on the side. And once we break down, and I can tell that we actually broke down to some type of level, this is when I would potentially enter bigger short positions. And we don't just blindly just keep shorting the market as it goes up just because we have a bad feeling or an ego or anything. So this was my video for today. I put up the bearish case on the stock market. I put up the bullish case on the stock market. So I hope you are enjoying these videos. If you are, please press the like button and maybe consider subscribing. So I hope to see you in another one.